Hello, welcome to IGTV. I'm Angeline Ong, and we're focusing on fund flows in this investment show with senior investment consultant at Square Mile Research, Jake Moeller. Jake, thank you so much for joining us. There's been so much volatility. The banking crisis as well has spiced things up for our clients and investors. It seems to have stabilized now. What do you think about this before we start talking about fund flows?
It's been a quarter of 3 months, literally and figuratively. First month, you had everything's back to normal. Investors seem to be quite confident. February, you had the Federal Reserve hawkishness come back in and the US jobs data, which startled people again. And then, as you say, you've had the volatility induced by the banking crisis, or mini banking crisis, as I see it, in March. So each of those particular events has driven fund flows in the March quarter.
Are there any more skeletons lurking in the closet?
There's always skeletons, Angeline, always skeletons. I think the question is the contagion of this banking crisis. I don't think it's a fully fledged banking crisis. I don't feel like it's one, having worked through the last one. There haven't been any rights issues by the banks yet. There have been, calls have been made on all the debt. So those sorts of signals haven't been reached. Does this financial situation tip over into the real economy, I think, is the question we need to ask ourselves. The jury's still out there. If companies, if interest rates rising, stop spending or consumption, it might tip over into the real economy. If venture capitalists and private equity can't get funding, that could again spill into the real economy. So I don't see this as one of those pure banking crises that we saw back in 2008-9.
When do you think investors can look at the headlines and what's been happening with banks and go, oh, phew, the worst is over. It's now stabilized for good. We're not looking around and looking at the back of our shoulder to see if there's anything lurking. Are we there? I
don't think we are, Angeline. We're seeing average investment times in the UK unusually shorten. Typically, your average investor might want to invest for 5 to 7 years. That is coming down now towards 3 years. And that does reflect a certain skittishness. Those investors in mutual funds, they tend to have a longer term horizon than direct equities or commodities. What we have seen is a quite recent volatile flows in and out of mutual funds that are exposed to money markets and some more conservative funds. I don't see that necessarily changing, but we are seeing a slight return to a longer term time horizon, especially for equities.
Interesting that you talk about that skittishness as well, because I'm just looking at the global fund flows, and in terms of money market, we saw $50.5 billion in terms of flow in the last month or so. Is this going to continue? Are we seeing a stabilization?
Interestingly, money market flows have always been susceptible to a fear of the unknown or risk aversion. What you've got at the moment, though, is as interest rates have gone up, they've become slightly more attractive. So typically flows into money market will come out as quickly, possibly a month later. But because interest rates are higher, investors are staying there for slightly longer at the moment. Also, the retail investors themselves are probably investing slightly more in money market funds because they're scared of deposits in the banks. So that's had a bit of a knock-on effect as well. So I think that will probably bounce back. I think the Calastone data came out recently, and that's shown that March has been a very good month for equity flows in the UK especially. And that's a pattern I think that is more normal from my experience.
Just give us a sense of the breakdown. Where is the smart money headed if we're seeing this transition into equities, if you like?
The investors that I deal with are certainly looking for more conservative equity portfolios. So they're looking for companies that invest with good balance sheets. They're looking for low gearing. A lot of investors now are moving away from the growth story that has been driving markets and are looking more towards the value side of things. I deal with a lot of clients who are asking after dividend income funds, right? And global mandates. So if you think for a moment that, some 50% of the MSCI world is now yielding more than 1.5%, that gives dividend income investors a great pool in which to fish. So you have slightly lower volatility profile for stocks that have good dividend cover. And I think that's a lot of investors are finding that quite attractive at the moment.
Jake, is this caused in part by what we're seeing in Ukraine and also the energy crisis and the slow reopening of China? How much of this is playing into this mix of equities that your clients are preferring?
It's all in the mix, absolutely right. If you look at the way that the macro environment has become so unsettled just after COVID, it really hasn't given investors time to catch their breath. But even with interest rates rising as they have, cash still for many investors isn't a long-term proposition. So they have to adopt some risk in portfolios. So the way to do that is to accept that there is a lot of geopolitical risk going on at the moment, noise, and try and find a way through that. Good companies are good companies and are finding a way to navigate these storms. Good capital discipline is going to see you through all sorts of geopolitical crises. The investor really does need to sort of identify those opportunities.
How about in terms of mixed assets, fixed income, for example? Are you seeing any trends there?
Yes, we are seeing, certainly I mentioned the global equity income. There's pockets of popularity in UK smaller companies, for example, so there's clearly some risk appetite for longer term growth investors. Mixed asset funds are certainly increasing, and this is on the basis of the demographic of investors' ages now. People are looking for solutions-based investing. The flip side to that, of course, is last year was quite a bad year for mixed assets, with bonds being shaken up in the markets so badly. So little scares like that will often push investors back into a pure equity play with a conservative overlay. But certainly mixed asset funds are becoming increasingly popular as volatility continues.
Given the earnings season is almost upon us, and many of the forecasts that we've seen on Reuters, some of the forecasts I've seen on Bloomberg as well, are showing that this year it's going to be pretty much like a Ryanair landing. You know, you'll land, but it's going to be a bit rough. And certainly not as exciting as perhaps next year is going to be in terms of growth and recovery. So where would you advise clients to seek cover if they're investing this year?
I would suggest they seriously consider companies with very strong capital discipline, good return on invested capital, those companies that have got a few years of demonstrable growth in that. This is because they've already weathered the storm. Okay, we know that pricing power is good, but pricing power without good margins is not necessarily the way to go either. So you've got to have good active stock pickers that are able to see through the company's moats, but you want that capital discipline. You want good dividend discipline. You want good inventory management. And you want to make sure that you've got a good captain steering the ships of the companies that you're investing in.
Right. So good leader, good dividends, and good inventories. That's stuff that you're looking out for that investors like. How about trends and what investors are avoiding? And that's also key for our clients because they also have this ability to short. What are the trends telling us about what investors are avoiding?
I think you've mentioned something already, Angeline. The earnings season, a lot of analysts will be looking towards whether the tech, to what extent tech can stay as a prominent part of the market. A lot of these tech companies, NVIDIA you've mentioned, as long as they are producing good earnings, should be able to stay buoyant. But as soon as some of these tech companies miss earnings targets or are revealed to be lacking in their earnings, this could be something that sends off that company into a bit of a tailspin. Companies that are speculative, that don't have, that have raised money, that don't know quite what to do with it, if they're sitting on a lot of cash and they're not buying back stock, you've got to have managers that are really investing to make sure that the moats of these companies are strong. I would avoid anything that's too highly leveraged. We know that in periods of volatility, high leverage is really, really bad. So leverage in itself isn't bad as long as it's structured properly. If you've locked yourself into some good low interest rates, probably not as bad as a lot of the same amount of leverage with shorter rate exposure. So avoid leverage. That would be one of my tips.
Right. Thank you very much, Jake Moeller from Square Mile Research there, talking to IGTV. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.